Hi, this video is about how does student loan interest work. So interest can be your friend, the good kind of the interest that make your investments grow from a couple of the $100 bills to mountain of the cash, and that's it. But what amount about when it's loan interest? That is totally different story. The way interest works can on a loan means you need and up paying way more money that you are originally bought. It is the worst. To figure out your loan interest, you have to understand a few terms. Boring, I know, but stay with me. Loan payment term, that's how long you have to pay the loans back. For most federal loans, that will be 10 years, but it can take up to 30 years. For private loans, the term can be based on the term of your loan agreements. Interest rate, it is how much interest you will be paying on the loans. Federal loans rate percentage can vary per loans, but they are usually fixed, meaning the interest stay the same every year. Private loans are typically based on your credit rating, so they can vary a lot, and they can be fixed or variable. Principal, this is base amount you owe for the loans, not including interest. So if you took out $35,000 in loan, your principal would be $35,000. That's the average amount of the debit each student's loan borrowers will graduate with the. By the way, so here's the math, everyone's favorite part. Let's take that $35,000 principal and say you have the 10 years loan repayment terms with a fixed interest rate of 5%. Typically, interest rates can average from 3.75 to 5.28% depending on the loan type. With those numbers, your monthly student loan payments would be just over 370 $370, and the total amount of the interest you would pay during the long term would be almost $9,550. So you might have started out by borrowing $35,000, but in the end you would really pay about $44,550. Are you feeling sick yet? um, Student loan repayment option. If you decide to take out student loan, which is already no you want to because you promised, you also make a decisions for your future self, the decisions to spend the next 10 or more years of your life making monthly payment. Don't be a jerk to your future self. Here's a quick look at what could be dealing with. Repaying federal loans, standard repayment plans. The government or your lender provides a schedule with the set monthly payment amount. For federal loans, the plan is for 10 years. Private loans will be very graduated repayment plans. The payments start off lower, but they increase every couple of the year or so. The plan is still to have everything paid off in 10 years. Extended repayment plan. These plans extend the payments beyond the normal 10 years window for borrowers you have more than $30,000 in outstanding loans. The payments could be fixed or graduated, meaning the payment increase little by little and are designed to pay off the loan is 25 years. Income based repayment plans. These are the plans based your payments on a percentage of your income. Usually you will pay between 10 to 15% of your income after taxes and the personal expenses and covered. The payments are recalculated every year and adjusted for things like the size of your family and your current earning. income contingent payment plan. This is the similar that the income based plan, but it's based on the 20% of your di- discretionary income. That's the amounts of income you have left after your set expense are taken off. The rates are adjust every year, and the balance can be forgiven and taxed over time, usually 25 years.